When interest rates move, debt markets are bound to see a reaction. And now we are slowly seeing global central banks cut interest rates. What does it mean for debt mutual fund holders? To discuss this, I have with me Deepak Agarwal, the Chief Investment Officer for Debt and Head of Products with Kotak Mahindra Asset Management Company Limited. Hi Deepak, and I must start off by asking you about the US Fed's action, the cut in interest rates after many years. Let's get in your overall take on that.
Yeah, hi Mubina. Yes, see, broadly, Fed has done a fantastic job of achieving soft landing, where inflation, which was the core PC, inflation which Fed is targeting, was close to 5% in calendar year 2022. This year it has come down to closer to 2.7, 2.8. And Fed is also giving a guidance that next year the core PC is likely to average around 2.25, 2.5%. Now, since inflation has come down, Fed is also rolling back the hikes which they had done. They have started with a 50 basis point rate cut, and in addition to that, Fed is guiding close to 50 basis point rate cut more this year, and they are guiding 100 basis point rate cut next year. Now, including this week cut, the cumulative cuts would be close to 200 basis point. And let's say if based on Fed's guidance, if next year inflation is at 2.25%, and Fed comes down to around 3.5%, then still Fed is maintaining 1.25% real rate. So, because Fed has achieved a soft landing, and since inflation trajectory is lower, Fed has started cutting rates. And though market is pricing, let's say Fed fund futures, if you look at Fed fund futures, they are indicating by Jan 2026, Fed will be down in the band of 275 to 3%, 50 basis point lower than what Fed is guiding. But our view is that probably the amount of cuts would be in line with what Fed has guided. First cut, we had a 50 basis point rate cut, but now going ahead, we believe that the quantum of cuts could be lower, and we'll have 25 basis point rate cut.
Now all eyes are going to be on the Reserve Bank of India. Do you think they'll take cue from the US Fed, or perhaps there are other factors internally that will determine the way the MPC will move?
So, internally, if you would have been listening to our commentary, we thought since our inflation is now averaging around 4.5% and repo rate at 6.5%, our real rates are close to 200 basis point. And for last 6 months or before any monetary policy, we were of the view that RBI should have actually changed its stance to neutral. But RBI continues to maintain withdrawal of accommodation. In fact, if you look at two external members who are due to retire, basically Professor Jayant Verma and Dr. Ashima Goel, they have also been of a view that RBI should have actually changed the stance. And in fact, these two members have been voting for a rate cut. But RBI is delinking itself for the time being with Fed. The commentary suggests that they want to decide monetary policy based on domestic factors. Inflation for the month of July and August was lower, closer to 3.5, 3.8. But now inflation for the rest of the half is likely to be in the band of 4.5 to 5%. Growth is also strong, though RBI is guiding 7.2% in growth for FY25. We believe that growth this year might be relatively soft, closer to 670, 680, but it continues to remain strong. So probably, yes, given rate cuts globally, RBI also has space to cut rates. RBI can bring down the real rates from 200 basis point to 150 basis point. However, we think RBI will go slow. We think a good possibility that RBI is changing the stance in the next week RBI policy, and probably we have the first rate cut in the December policy. Now, as against 200 basis point rate cut in US, we believe we'll have a very shallow rate cutting cycle in India. And for the time being, we believe that RBI is not cutting more than 50 basis point from, let's say, over the course of next 1 year.
What is your outlook on how yields may move from here on?
In our past commentary, we have been suggesting, let me give you a global flavor, that across calendar year 2023 and let's say 3 months earlier, the yield curve was inverted in US. US government was borrowing 2-year money at an expensive rate than the 10-year money. And throughout we have been communicating that when Fed starts cutting rates, the yield curve is likely to steepen. And if you look at the current yield curve in US, the yield curve is already steepened. 2-year bonds are now trading closer to 350, 55, and 10-year bonds are trading in the band of 375 to 380. So the yield curve has steepened there. Similarly, in India, right now, the GSEC yield curve, if you look, there has been some amount of steepness, but the steepness is not huge. And we believe that as rate cut begins, and plus, let's say, RBI has come out with a guideline where banks may be required to keep some additional GSEC in order to have appropriate liquidity with them. So that will also result to GSEC demand at the short end. Rate cuts with demand for GSEC at the short end will result in steepening of the yield curve over the period of time. However, currently if you look at the corporate bond yield curve, the corporate bond yield curve is currently inverted. Basically, banks are trying to correct their credit deposit ratio, which is resulting in higher issuances from bank, which is keeping short-term rates elevated. And investors are preferring to buy long-term instruments, and therefore they are buying it at lower yields because they believe yields will trend lower. So the inverted yield curve in the corporate bond segment is also likely to steepen over the course of next 1 year as rate cuts begin and market gets more assurance that liquidity will be there in the system.
And finally, what's your advice for debt mutual fund holders? What should their strategy be?
I think from Jan 2024 onwards, we have been asking investors to increase the duration of their portfolio, and we have been recommending them to select longer duration funds. Currently, let's say from Jan till date, 10-year GSEC yield has trended lower from 710, 715 to some closer to 675. Given the index flows, given the additional GSEC demand due to the revision in the LCR guidelines, we believe that demand is higher than the supply, which will result in long-term yields trending lower. So a 10-year GSEC, which is currently trading around 675, we believe by March 25 could be lower by 25 to 40 basis points. So the case for investing in longer duration fund continues, and investors can consider, let's say, long duration funds, dynamic fund or gilt fund for taking the benefit of drop in long-term yields. Apart from this, let's say what we have seen over the course of last 3 months is that long-term yields have trended lower, but short-term rates are more or less elevated. And therefore, we believe that the risk reward also merits investment in medium duration funds. And therefore, investors should also look at medium duration funds for investing, let's say, for next 9 to 12 month investment horizon.
All right, Deepak, many thanks for joining us. That's the word coming in from Deepak Agarwal. Thank you so much for watching. Stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.